Hi everyone, I'm Yang. My project topic is arbitrary pricing theory, or APT for short, multi-factor generation. This is a quick outline of what I'm going to talk about. I will give you a quick introduction and background of APT. There will be a look at the method of analysis used in the theory, followed by conclusions. The basic problem of investment is to predict the rate of return of an asset. We have learned CAPM in class, and it is based on portfolio theory and assumption that price is in equilibrium state, but the model's assumption is too ideal, so it does not quite fit reality, and it is difficult to test or apply. APT is developed by Stephen Rose. Compared with CAPM, it is based on fewer and less restrictive assumptions. It is also more general. CAPM allows one risk factor, as APT allows more factors. APT is building on the early work of factor model. The most important assumption is that there is no arbitrary opportunities in the market. This section introduces factor model. This is an equation of single factor model. We assume that alpha and beta is constant, so the rate of return of an asset is determined by market index and random error. We could use data and the market index to predict rate of return. APT has less restrictive assumption than CAPM. It assumes that first, markets are perfectly competitive and frictionless. Second, investors prefer more wealth to less wealth and are risk averse. Third, individuals share the belief that the stochastic process underlying the generation of securities returns over time can be simplified in the form of a linear multi-factor model. And let's talk about linear multi-factor model. APT assumes that rate of return is in the form of a linear multi-factor model. This is the equation. Ri is the realized return earned by asset I, and the total number of assets is capital N. ERI is the expected rate of return of asset I. Fk is risk factors. It is used to describe the unexpected movement in the system. Its expectation is zero. Bik is a sensitivity coefficient. Ei is a random error term. Random error for each asset is uncorrelated, and their expectation is zero. To make it clear, we can divide the right side into two parts. First part is expected return, which is known by all shareholders. Everyone shares the same information. Second part is uncertain or risky return. It is unanticipated, so the return can be expressed as announcements equals to expected part plus price. Unanticipated part can be subdivided into systematic and unsystematic. Systematic risk may influence all assets in the market, for example, GDP, development of technique, price of raw material. On the other hand, unsystematic risk influences the asset itself. To simplify, these slides look at single factor. All assets return can be expressed as expected return plus BIF plus EI. A portfolio includes N assets. Weight of I assets is WI. It is easy to get the variance of portfolio. BP is average of BI. It is undiversifiable, but sigma EP square tends to zero when N is large, so unsystem risk is diversible. The most important assumption of APT is that it allows no arbitrage opportunities. Arbitrage opportunities allows investor have positive return with no wealth and no risk. If arbitrage opportunities exist, the action of arbitrageurs will quickly result in the price of underpriced assets being bid up and overpriced assets being bid down. From that we can know if two assets have the same risk sensitivity, they must have the same expected return. By applying this restriction, we obtain the expression of expected return. In this equation, lambda k is constant for the same factor k. Lambda 0 is risk-free rate, so if we mark it on graph, we can get this. This figure gives us a good insight into linear correlation between expected return and sensitivity BI. To simplify, this is under single factor condition. All expected return should be on the line. Intercept of the line is risk-free rate. Slope is lambda. If any expected return falls above or under the line, there should be an arbitrage opportunity. Let's talk about applying APT. First, finding factors. Factors may be interest rate, GNP, inflation, stock market index, or any other factors influence the rate of return. Second, building portfolios. Third, sensitivity analysis. Finally, let's draw conclusions. First, APT subdivide the systematic risk into different parts, allow multiple sources of risk. Second, APT measures the sensitivity of each asset to each risk factor. Therefore, APT makes a selection of the portfolio accurate and has a guiding significance for portfolio strategy.
Hi everybody, my name is MD Islam. Today I am presenting the hedge fund and its history. So, what is the hedge fund? It is the nature of humans to fear what it is they don't know or understand. Narrated by Rod Serling, the creator of the Twilight Zone. A hedge fund can be defined as an actively managed, pooled investment vehicle that is open to only a limited group of investors and whose performance is measured in absolute return units. Since 1990, it has been one of the proven and fastest growing segments of asset management due to its many different kinds of strategy. It does not measure themselves against traditional market benchmarks, but instead target achieving positive returns in both rising and falling capital market environments. Overall, it contributes to the growth of the modern financial industry. Hedge fund structures. Hedge funds are clearly recognizable by their legal structures. Many people think that they are completely unregulated. But it is more accurate to say that hedge funds are structured to take advantage of exemptions in regulations. The legal structure of hedge fund is intrinsic to their nature. Flexibility, opaqueness, and aggressive incentive compensation are fundamental to the highly speculative, information motivated trading in strategy of the hedge fund. These features are in conflict with a highly regulated legal environment. The United States has been the center of the hedge fund activity, but about two-thirds of all hedge funds are domiciled outside the United States. Often these offshore hedge funds are established in tax sheltering locales such as the Cayman Islands, the British Virgin Islands, Bermuda, the Bahamas, Luxembourg, and Ireland, specifically to minimize taxes for non-US investors. US hedge funds often set up a complementary offshore fund to attract additional capital without exceeding SEC limit on US investors. The history of hedge fund. Clearly, hedge funds have been played an important part in the expansion of capital market in recent years. The number of hedge funds around the world exploded from 610 in 1990 to approximately 9,000 by end of 2008. Over the same period, the industry asset under management grew exponentially as well, from 39 billion to 1.9 trillion dollar by the second quarter of 2008. The history of hedge fund continued. In 1949, Alfred Winslow Jones started an investment partnership that is regarded as the first hedge fund. Remarkably, many of the ideas that he introduced over the 50 years ago remaining fundamentals to today's hedge fund industry. By the mid 1960s, Jones' fund was still active and began to inspire imitations, some from investment managers who once worked for Jones. An SEC report documented 140 live hedge funds in 1968. A stock market boom begins in late 60s, led by a group of stocks dubbed by Nifty 50 and hedge funds that allowed the Jones long short style appeared to underperform the overall market. During the late 90s, the largest tremor through the hedge fund industry was the collapse of the hedge fund long term capital management LTCM. LTCM was the premier quantitative strategy hedge fund, and its managing partners came from very top tier of Wall Street and academia. From 1995 to 1997, LTCM had an annual average return of 33.7% after fees. At the start of 1998, LTCM had 4.8 billion in capital and positioning totaling 120 billion dollars on its balance sheet. The explosive growth in hedge funds led to the market for professional managed portfolios of hedge funds, commonly called funds of funds. Funds of funds provide benefits that are similar to the hedge fund but with lower minimum investment level, greater diversification, and an additional layer of professional management. Since hedge funds are structured to avoid regulation, even disclosure of the existence of hedge fund is not mandatory. There is no regulatory agency that maintains official hedge fund data. There are private firms that gather data that are voluntarily reported by the hedge funds themselves. This gives an obvious source of self-selection basis, since only successful funds may choose to report. Hedge fund fee structure. Hedge fund managers are compensated by two types of fees. A management fee, usually a percentage of the size of the fund, measured by AUM, and a performance-based incentive fee, similar to the 20% of profit that Alfred Winslow Jones collected on the first hedge fund. Feng Shi 1999 determined that the median management fee is between 1 to 2% of AUM and the median incentive fee is 15 to 20% of profit. To ensure profits are determined fairly, high watermarks and hurdle rates are sometimes included in the calculation of incentive fees. A high watermark is an absolute minimum level of performance over the life of an investment that must be reached before incentive fees are paid. A high watermarks ensure that a fund manager does not receive incentive fees for gains that merely recover losses in previous time periods. The presence of incentive fees and high watermarks may complicate the calculation of the value of investor's share. If investor purchase share at different times with different net asset value NAV, NAV calculation of incentive fees may treat the investors differently. Minimum investment levels for hedge funds are usually high, implicitly dictated by legal limits on the number of investors who are not high net worth individuals, qualified purchasers, or accredited investors, and restrictions on promotion and advertising. Funds of funds, portfolio of hedge funds are an increasingly popular way to invest in hedge funds with a much lower minimum investment. Funds of hedge funds usually impose a 1.2% management fee and 10 to 20% performance fee in addition to existing hedge fund fees. In order to compare performance, risk, and other characteristics, it is helpful to categorize hedge funds by their investment strategies. Strategies may be designed to be market neutral or directional. Long-short hedge funds focus on security selection to achieve absolute returns, while decreasing market risk exposure by offsetting short and long positions. Related value funds use market neutral strategies that take advantage of perceived mispricing between related financial instruments. Event driven strategies exploit perceived mispricing of securities by anticipating events such as corporate mergers or bankruptcies and their effects. The technical trading classification includes a large variety of directional strategies, including the subcategories of global macro and commodity trading advisors. Risk management. In this chart, it is obvious that with the hedge fund, it is possible to reduce the risk and increase the return. Risk management continued. The name hedge fund seems to imply risk reduction, but this need not be the case. It is better to think of a hedge fund as a fund that hedges away any risk not related to its speculative strategy. The riskiness of a hedge fund therefore depends intimately upon its strategy. This contrasts with a traditional active fund where most of the risk come from the benchmark and a minority from the active portfolio strategy. There are two standard approaches to measure portfolio risk: the variance based approach and the value at risk approach. These two approaches are not incompatible, and many portfolio managers use both. Hedge fund performance measurement. Hedge funds have, for the most part, succeeded in achieving their goal and in preserving capital during bear market. From 1990 to 2008, the industry experienced only two down years, weathering difficult periods like the Mexican peso crisis, the Asian financial crisis, the collapse of long-term capital management, the bursting of the dot-com bubble, and the collapse of the credit market in 2001-2002. From a performance perspective, hedge funds have been successful in achieving their objective of providing consistent returns that exhibit low correlation to the broad equity market while maintaining low volatility. Conclusions: including a group of broadly diversified hedge funds in a traditionally allocated portfolio of stocks and bonds has been shown to potentially reduce portfolio volatility and increase returns. The investment environment for hedge funds going forward 2010 and beyond could be attractive. Investment strategies that can make money in rising and falling equity market, such as those employed by many hedge funds, are better positioned for success in an uncertain or volatile economy. Hedge funds and the interests of the constituents are better aligned now than they were prior to 2008. Due to the fallout of 2008 and the Bernie Madoff scandal, investors are assigned more value to the strength and integrity of a firm's risk control and procedures when conducting due diligence on potential hedge fund investments, as opposed to focusing only on performance. Investors are seeking better transparency, better liquidity, and more appropriate fee structures from funds. The investors are requiring the use of independent third-party service to support funds operations, manage custody of their assets, and verify their pricing. Fund of hedge fund will continue to be a major channel into hedge funds, providing more investors ease of access and exposure to a broad range of investment style and strategy, along with a additional level of risk management. The materials of this presentation has been taken from the following articles.
My name is Rodrigo Vergara Bosem, and together with my classmate Jiming Chu, we're going to talk about the development of the Black-Scholes model.
Let's start our presentation with the agenda for today. We are going to start with the overview of the Black-Scholes model, what the model is, a description of the model and the pricing formula. We're going to continue with the history of the model development, basically past, present, and the future of the model. We are going to discuss the model assumption and its limitation associated with the model. Our research focused on these limitations and how the extension of the model resolves these limitations. Then we're going to end with our conclusion and show you a list of reference. What is the Black-Scholes model? It is a mathematical model of the financial market, which does option validation. It has a huge influence in the market. Traders use this to price and hash options. The innovation of this model lead to the explosion of option trading. This is the Black-Scholes pricing formula. It consists of two terms. The term on the left is the cash influx into the portfolio, corresponding to the pseudo probability in the expectation of the stock price. The term on the right gives the time value of the money adjusted at the payment of the exercise of the options. The objective of the Black-Scholes model is that if you take two risky positions together in the right proportion and form a portfolio, that you can eliminate risk totally. The rate of return of this portfolio should equal to the risk-free rate to avoid any arbitrage opportunity. And the result of this lead to the development of the option pricing formula we showed in the last slide. Now, what is the arbitrage opportunity here? Let's say if the portfolio rate of return is higher than the risk-free rate, you can always borrow money at a risk-free rate and then invest in this portfolio. On the other hand, if the risk-free rate is higher than the return of this portfolio, then you can always short the asset and then buy risk-free security.
Let's talk about the history of the model development. In 1990, Louis Bachelier uses a series of equations to create the first mathematical model of the market. Before the model was developed by Black and Scholes, academics developed many mathematical models, usually very complicated, that added a lot of variables, such as utility functions, to try to estimate the risk aversion, aggressiveness, and many other variables that were related to the mood of the investors in order to predict the variations in the stock market. By the end of the 60s, academics weren't any closer to a real formula or model to predict these movements. In 1968, Myron Scholes and Fisher Black started to tackle the problem of option pricing. By the early 1970s, Bob Merton had developed a reputation for using exotic and abstract mathematical ways to study financial contracts like options. He was a perfect person for Black and Scholes to contact. Merton turned to rocket science. He had studied the theories of a Japanese mathematician, Ito, who'd faced a similar problem to Black and Scholes. In order to plot the trajectory of rockets, you needed to know exactly where the missile was, not just second by second, but literally at all times. Ito had developed a way of dividing time into infinitely small parcels, smoothing it out until it became a continuum so that the trajectory could be constantly updated. Bob Merton used this idea and adapted it for the Black-Scholes formula. Using the notion of continuous time, the value of the option could be constantly recalculated and risk eliminated continually. In 1973, Black-Scholes model was published on the Pricing of Options and Corporate Liabilities, Journal of Political Economy. During the 1990s, the formula became very popular. Traders would actually program their formulas in their calculators to obtain the values of the options. In 1994, LTCM, Long-Term Capital Management, was founded. Scholes and Merton became board of directors of LTCM. The company made huge profits in the market using the model in the first 3 years. In 1997, Scholes and Merton received the Nobel Prize in Economics for their work. It is common belief that Black would have received that prize as well if he hadn't passed away a few years before. Also, in 1997, there were many factors around the world that couldn't be estimated or predicted by the model. One of them was the Asian financial crisis, where Thailand housing market busted. Also, in 1998, the Russian default led to a huge loss. In one single day, the company lost $500 million. For those reasons, the Federal Reserve agreed to an LTCM bailout in September of 1998. Currently, despite the temporary failure of the model, many academics research the topic in order to adapt it to real situations in the world. In order to come up with this model, there were many assumptions that they had to make. The first one is European style option instead of the American style option. In the European style option can only be exercised at expiration date, unlike the American style option where it could be exercised before expiration date. The second assumption is that the stock pays no dividend. The third assumption is that the price follows a Brownian motion. That means that the stock price follows a geometric Brownian motion with constant drift and volatility. It assumes that asset prices are log normally distributed so that the multiplicative model can be easily applied. The result implies that the change in asset price is proportional to the underlying asset price is normally distributed with mean and standard deviation. It also assumes a constant risk-free borrowing lending, and that there are no transaction costs or taxes, which we all know is not applicable to the reality. It also assumes an efficient market. It assumes that the market is perfectly liquid and continuous hedging trading of stock options is possible at any time. Let's analyze the first limitation. European style no dividends options. It can be shown that in absence of dividends, American options should never be exercised early. Black suggests an approximate procedure for taking account of early exercise in a call options. This involves calculating the prices of European options that mature at times t and tn, and then setting the American price equal to the greater of those two. This approximation seems to work well in most cases, where capital T is the expiration date and Tn is the dividend payment period. With this approximation, the assumption is that the holder has to decide today whether the option will be exercised after a dividend payment period or the expiration date. Whereas in Roll, Jusk, and Whaley formula, the assumption is that the decision is made after every dividend payment period. In RGW, that stands for Roll, Jusk, and Whaley, dividends are always applied to stock price less the present value of the dividends.
The next limitation we will discuss is that the stock price is assumed to be following the geometric Brownian motion with a constant drift and volatility. The model also assumes asset prices are normally distributed so that the multiplicative model can be easily applied. Now, this result implies that the change in asset price in proportional to the underlying asset is normally distributed with mean of mu and standard deviation of sigma, as shown in the equation. You will notice the term mu, or the expectation of the portfolio's return, is being dropped in the final expression of the model. The mean is a function of the investor utility function and risk aversion, which are impossible to model, so it makes sense it's being dropped in the final expression. In our research, we did not find any other statistical model that has a better fit of the behavior of the change in the stock price. The next limitation we will discuss has to do with the constant volatility assumed in the model. Volatility is a measure of the standard deviation of the stock return, which is the only parameter in the Black-Scholes pricing formula that cannot be directly observed. All the other parameters like the stock price, maturity, risk-free rate are pretty much deterministic. There are two classes of volatility, one being historical volatility, which measure the fluctuation of the stock price over the past trading period, let's say 30 days. However, trader in practice, they use implied volatility, which is an estimate of the market opinion of the derivative contract itself and not the underlying asset. Regardless of the class of volatility that we use in our Black-Scholes model, constant volatility is probably not very realistic due to two reasons. One being volatility clustering, and number two being the leveraging effect. Volatility clustering refers to the fact that large price change tends to follow by another large price change and vice versa. you can refer to the top left graph where it shows volatility clustering of the S&P 500 between the date of 84 to 1987. And the second point of leveraging effect means that the volatility of the derivatives usually negatively correlate with the asset's return. There are other options market behavior that can dramatically impair the use of the constant volatility value. Some of the situation like an upcoming drug trial for a pharmaceutical stock, a patent litigation resolution for technology stock would create volatility swing that makes the use of a constant value infeasible. Our research has found that this volatility parameters is well being discussed across a lot of literature. Stochastic volatility in the form of volatility smile and the two-dimensional format, volatility surface in 3D, and the evolution of volatility in four-dimensional space are being well fed into the Black-Scholes model. The inclusion of stochastic volatility would require finite different computational method, which basically discretize a continuous time scale into small pieces in time. Now that would become very computationally expensive to be accurate. However, our findings that there is Heston model which describe the evolution of volatility pretty well and has a computational advantage due to the existence of a fast, easily implementable solution with the fast Fourier transform.
The last limitation that we're going to discuss in this presentation is the transaction cost. This limitation could be treated the same way as we analyze the payment of dividends, adding on an amount to the initial cost of the option which reflects expected transaction cost. The problem with that is that it created a lot of difficulties in the computation because the transaction cost changed with the stock prices. A better approach is the one that Leland took in 1985. He went through the fact that every transaction has a fee involved. Because of this, an intuitive explanation for adjustment of models with transaction cost is inclusive of transaction cost, the net price of purchasing is slightly higher than without transaction cost. Similarly, the net price of selling stock is slightly lower. This explanation of up-down movement of the stock price can be modeled as if the actual stock price is slightly higher or lower. The result of this is a model with a higher volatility. As a result of our research, we can conclude that the Black-Scholes model is a simple mathematical framework to model market dynamics. It is also a very good approximation tool for option values, although we did analyze that it's not a perfect tool and that there are many factors around the world that are very unpredictable, such as economical crisis like the one in Russia or Thailand. Many assumptions were made to achieve this model. For that reason, there are many restrictions or limitations. These limitations don't stop the model from achieving very good results. Because of these limitations or restrictions, this model serves as a basis of analysis for many more complicated models in order to achieve more realistic values for specific situations or scenarios. This concludes our presentation on the development of the Black-Scholes model. Thank you for your time.
Hello, welcome to IE590 Financial Engineering. We are a team composed of Zach Floor, Jason Lee, and Shannon Rigney. And for our final presentation, we are going to talk about portfolio insurance. Our agenda for this talk consists of 4 different directions. We're going to first introduce you to the topic of portfolio insurance. We'll enter some basic terminology to help us understand what is happening with portfolio insurance. We'll give you a brief history of our topic, and we'll end with some past and present examples of portfolio insurance strategies. So what exactly is portfolio insurance? Simply, it's a utopian, perfect idea of how we can minimize any potential losses in the financial market. So especially in a declining market, it answers the question of how can we hedge against any loss? There's an obvious solution. We could pay some insurance premium, like any other type of insurance, to hedge yourself, to never allow yourself to fall below a specific range. Insurance exists in other markets, from home, automobile, and life insurance, so it seems natural that portfolio insurance could work the same way. Leland was a finance professor at Berkeley back in the later 70s, and he still is to this day. He spent most of his time worrying about his family finances in the turbulent market of 1976. His brother noticed a trend in the market, though. Many pension funds had withdrawn from the market due to the decline, so he thought that if some type of insurance existed, it could keep different investors in the market. Leland joined up with his colleague Rubenstein, who was another professor of finance at Berkeley, to be able to come up with portfolio insurance. Rubenstein was very gifted when it came to understanding options as well as computers. So the two joined heads and created Leland-Rubenstein to be able to market their portfolio insurance. Rubenstein worried about the idea. With the insurance and the frequent trading of stocks, he worried about the large transaction costs. Because essentially, portfolio insurance is a dynamic and constantly trading being. Before the duo could develop a system to market, they needed to decide on what market they wanted to target. So who would use this idea, and what type of investors would be part of this? Now, this mindset and thinking directly clashes with the normal assumptions of the financial model. Now, often we assume a homogeneity of persons in a market where each person has the same wants and wishes and will make the same decision. So, first, Leland and Rubenstein had to define the types of homogeneous people who would use insurance. Now, they decided that these would be the investors with average expectations, but who allow more risk as their wealth increases more rapidly than the average stock. Now, this would encompass any investor who holds the safety-first mindset. He would benefit from insurance, as it would never allow the value to go below a certain level. Now, this would work well with large institutional funds, like pension funds. The second demographic would also be investors who, on average, are more risk-tolerant, but they're equally more hopeful than the average person for a positive return. So, for example, if someone has a large portfolio that is well diversified, and it's reasonably expected that they will be able to make a good positive return, portfolio insurance would ensure the ability to have the return while keeping the risk at a lower level. So Rubenstein and Leland co-pitched their idea. They published a very famous paper, Who Should Buy Portfolio Insurance? And their company even created and sold software to help investors hedge their portfolios. Now, portfolio insurance is very similar, if you think about it, to having a portfolio and buying a put that has a strike price equal to the initial portfolio value. So when insurance is purchased, we can represent the return with the following equation. Let's let x naught equal to the beginning value of the stock, and x of t equal to the final value of the stock. Now with this equation, the investor will either get the final value, only if the final value is larger than the original value, or the original value. Neither way, the investor pays the premium. So how can we obtain portfolio insurance? Now, if the options exist in the market, the person holds their portfolio and purchases the options to be able to hedge their portfolio. So in markets where the options do not exist, insured returns can be gained when continuous trading is allowed. Now these returns are log normally distributed, which allows for calculations and expectations for the returns. You have to trade your assets to reach a specific return while you're minimizing risk, which we've seen this in many models that we've learned in this course. Now this model can be viewed as two different groups sharing one random return. So both the outcome of the stocks and the options are based on the return and volatility of the market. So what exactly happened with the company? Well, they scored their first client at the beginning of 1980. There was a massive demand for their product, drawing in many competitors to rival them for the market share. By 87, they had nearly $60 billion in equity assets covered by portfolio insurance across the map. Now the key point was the software that they developed helped to trade stocks during downticks, acting as put options to balance the portfolio. But the software was very risky. So now that we have a brief overview of the background of it, let's talk about some strategies and some interesting applications of this portfolio insurance. Some strategies are stop loss, option-based portfolio insurance, option-based portfolio insurance with an option replication, as well as constant proportion portfolio insurance. First, the stop loss strategy. Now, the entire portfolio is initially invested into a risky asset. But as soon as this risky asset, let's call it S, drops below the price floor, let's call that F, the entire position is rebalanced into a risk-free asset. Now, when the market rebounds after hitting this floor, the fund is then reinvested back into the risky assets. Now, this kind of strategy is not efficient. Now, when returns are predictable, stop-loss strategies are unable to use relevant information from the time the strategy is implemented up until the time where the contingent sell order is executed. Now, when returns are unpredictable, selling a losing investment before the end of the holding period doesn't necessarily guarantee that the investor will be better off at the end of the holding period. Now let's compare two different stop-loss strategies versus a buy-hold strategy. Now the first strategy says that once the floor is hit before the end of the investor holding period, the investor sells all of his holdings and then reinvests the proceeds into the S&P 500. Now the second strategy says once the floor is hit before the end of the period, the investor sells his holdings and reinvests his proceeds into a risk-free asset, which is a 1-month T-bill. And the buy-hold strategy says that the investor holds the underlying stocks for the entire holding period. Now the results of this comparison are that both stop-loss strategies can reduce the effective holding periods on losing investments. They are able to reduce the investor's losses only on certain stocks, but not on others, but they help investors reduce their risk. However, generally speaking, stop-loss strategies neither reduce nor increase losses relative to the buy-hold strategy. Now we're going to talk about option-based portfolio insurance. This consists of a portfolio invested into a risky asset covered by a put option. Now, no matter the value of the asset at the end date, the portfolio value will always be better than the strike price. This method allows one to get portfolio insurance at any time, but it must be synthesized using a dynamic replicating portfolio consisting of a risk-free asset and a risky asset. Now, because of the European put with a suitable strike price, the maturity is probably not available on the market. Now, let's define OBPI with the European guarantee with some simple equations. A riskless asset evolves according to this equation. The derivative of B of t is equal to B of t times R times the derivative of t. Now, B is our money market account, which is a riskless asset. R is our deterministic interest rate. Now, the derivative of S of t is equated using this equation, where W of t is Brownian motion, which is essentially a model to describe random movements, and R is our deterministic interest rate, as we've already mentioned before. Now, a person will purchase Q shares of S and Q shares of the European put options on S with a maturity T at the exercise price K. Now, we assume that Q is normalized so that Q equals I. Now, the value of maturity is governed by these equations, and due to the the parity between the put and the call, and the value at time t can be calculated using this equation. And this is the best in moderate bullish markets, where an investor who follows this approach puts a larger fraction of his wealth into an unconstrained optimal portfolio than compared to the CPPI approach. Now, this comes with a guarantee. Now, that American puts are not self-financing, so you can buy and hold them. Therefore, dynamic trading in the risky asset in American puts is an appropriate strategy. There are some drawbacks to this model, especially the issue of the payoff profile, which essentially is caused by the put option component. Now, the terminal value is equal to the guarantee if the put expires out of the money. Now, there is much high exposure in this gap risk, and as the probability is given by the real-world probability with the terminal asset price below the strike price of the put. Another drawback is the absence of liquid assets for longer maturities. Now, a potential solution is you could replicate this option with a self-financing portfolio, but that would be difficult. Let's define what option replication is. This is essentially a trading strategy which ensures that at a certain date, the payoff of an option without the trading of the option occurs. Now, for small changes to the underlying market parameters, the price of the asset and the price of the portfolio change in the same way. Now, that is key. Now, there are some advantages. This does not have a structured, a long-dated option, and it's easy to market and also to liquidate. But the disadvantages are this is an approximation, it's expensive, and it's also dependent on a model. Next we will talk about Constant Proportion Portfolio Index, or CPPI. This was introduced by Perold back in '86 for fixed income instruments. Now Black and Jones also wrote about this for equity instruments. It is a simple strategy to allocate assets dynamically over time. This consists of buying simultaneously a portfolio invested in a risky asset and a put option written on it. Now, dynamic investment strategy requires continuous reallocation of the portfolio that's corresponding with it. CPPI, which is a dynamic strategy, is a continuous reallocation of the corresponding portfolio. Comparatively, OPPI is a static strategy where there is no more rebalancing of the portfolio after the initial purchase. Once you purchase it, you stick with it. Now this leads to a question. Which strategy gives us a better guarantee of a minimum performance over a given period of time? Let's call this the horizon T. There's a stochastic dominance between the two. Now they rank two random variables, V and V star, according to a utility function. Now V star stochastically dominates V when the expected value of the utility function of V is still less than the expected value of the utility of V star. Now let's also look at the first order stochastic dominance. Now investors like more money rather than less money and are non-satiated. Now their utility is strictly monotone and is increasing in the income level without taking into account the associated risk. Let's look at the second order stochastic dominance, which restricts the model to only risk-adverse investors. Now there is a gain in utility from an additional unit decreases with the income level. This also has an increasing concave utility function, and it's a better representation of real-world investment behavior. Now let's look at the third order stochastic dominance, which also brings in ruin inversion. Now ruin inversion is also known as skewness. Positive skewness accepts a small, almost certain loss in exchange for the remote possibility of a huge return. Oppositely, negative skewness shows an unwillingness to accept a small, almost certain gain in exchange for a remote possibility of ruin. Now most investors would prefer positive over negative skewness. Now this third order stochastic dominance is modeled here on the left, but it's a little bit difficult to interpret from just the plot. So in situations where n equals 1 or 2, the CPPI strategy is more likely to underperform the OPPI strategy. But for higher values of n, CPPI outperforms OBPI all the time. However, risk associated with CPPI exceeds OBPI for n equals 4 and 5 in this situation. So in conclusion, let's wrap up a few key points from our presentation. Now, long-term European index options provide a perfect portfolio insurance, but this isn't available in exchange-traded markets, sadly. Stop-loss order strategies are extremely path-dependent, as the different equations have shown. Now, sequential index option strategies are path-dependent as well, but have a lower expected return rate. And lastly, this dynamic asset allocation, as shown with CPPI and OBPI, is as close to replicating long-term European indexes in the market. Thank you so much for your time, and I hope you enjoyed our presentation.